Alrighty. Hello, everybody. Happy Sunday. Hope you guys are doing well. Get audio check here on my end. Alrighty. Hello, everybody. Happy Sunday. Alrighty, guys. We made it to November. Hope you guys are all doing well. Happy Sunday to everybody here. Johnson, we are here waiting. Hopefully, it is worth the wait for you, sir. Jeff, happy Sunday. Eslam, glad to be here. Hope you guys are all doing well. Hope you guys had a restful weekend, and we are ready to get back to it here. A new month of opportunity here coming up with November, and ready to get to it, guys. Abraham, happy Sunday to you, man. Hope you're doing awesome. Alrighty, guys. So before we get into it here, I want to touch on a couple things. It is tentatively planned for non-farm payroll week, but as we know, the government is not open, so it is tentative on the economic calendar. So you guys will not see the non-farm payroll print this week unless the government miraculously opens up, which I don't think we're going to see anytime soon, but who knows? So with that being said, guys, do keep in mind it is non-farm payroll week, but we don't have the non-farm payroll print. So like I said, very interesting times that we're in now. I'm going to be trading same non-farm payroll protocol. So I'm going to be in there Monday, Tuesday looking to get paid and taking it light the rest of the week. So yes, we may not have the non-farm payroll print, but I'm still going to be following the same procedures. So with that being said, touch on the economic calendar bit. We will touch on indices, bonds, gold, dollar, the usual suspects here. Tough New York session this month. You know, on my live accounts closing out the month here, about break even. Really tough New York session trading. You know, and if it wasn't for my diverse understanding of price action and be able to go into all different times of the day and be able to find setups, it would be tough on the trading side. But because I'm able to diversify my income, trade different times of the day, different macro session setups, whatnot, I'm able to diversify my income because of the diversity in my analysis and not being limited to one session, because New York itself has been really tough, specifically from 9:30 to 11. So that time of the day has been giving me a little more trouble than usual, and I've been having to trade other sessions of the day just to compensate for that and still get the general returns that I'm looking for. So with that being said, that's one of the things that I've been doing to combat the more difficult, nasty price action we've been getting in New York. But hopefully we're going to clean up here going into the new month. A lot of things being thrown at the markets right now, and that should bring tons of volatility. So with that being said, guys, let's go and get into it. So let's start from the monthly chart here with US dollar. So we closed out the month of October here going into November, and we saw a bullish candle for the dollar for the monthly chart. The draw is going to be this this monthly fair value gap here. So we had a bullish month of October, just as the doctor ordered, looking to expand higher up into this swing high here. And again, you have to keep in mind, and I know I'm focusing on just the candle itself, but I want you to understand everything that goes into the analysis, because my goal is, again, for eventually all you guys to be doing this entirely on your own. So what you have to consider is where we're at in the range, right? I know I covered all this in great detail like 2 months ago, over 6 weeks ago, so I'll do a short refresher here for you guys. What have we seen with the dollar? Why have we been bullish? Because we dropped into a discount of the range. In and of itself, that's not enough. What's below equilibrium here in the discount? We have equal lows, sell stops. Below the sell stops, we have this last down close candle before this whole run up higher. That's a bullish order block. So we dropped down into a discount market, cleared the stops, and we're slamming into a bullish order block that's in a discount of the range. We then dropped on September's monthly candle. We swept the low here, quickly rejected and snapped higher. And now we're resuming bullishness. So it's all this context. It's all these underpinnings that, as you're going to see when we go into the daily chart and you're seeing bullishness, or when you're wondering, well, why is pound cratering, attacking the equal lows? Why is euro selling off? And it's because of all these things here with regard to the US dollar. So we're delivering from a discount, looking for a short-term premium up into this monthly fair value gap. That's the initial draw on liquidity for me right now. Hey, Joe. Hello to you, sir. Glad to have you. All right, now zooming into the weekly with the understanding of the monthly chart, we had this down close candle here we've been watching for the last couple of weeks as a bullish order block. We said as long as we stay above that, I am bullish. We hit it on the second week of October. From there, we rallied, and then we saw a nice expansion this week, taking out this high here. And then we had this wick here. You see I split that in half. We had that as an upside target. So when we were all the way down here, right, we were calling for the market to reprice higher to the 50%. We hit that, saw a bit of a retracement here, traded down, hit the bullish order block, and from there we've rallied. So obvious bullish institutional order flow. Nice expansion here this last week. And the important thing with how we closed last week is the fact that we laid a body over midpoint here, or 50% of that wick. That's bullish. That's what you want to see. So I like how we laid a body over that. Next draw is going to be this high up here. And then on the weekly chart, we have, let's move that to just the daily. On the weekly chart, we have this rejection block here, which is the highest close. That's what I have here with that dotted blue line. And then above that, we have the midpoint of the wick. And then above that, we have the high. So above this buy side liquidity pool here, these are all the levels of interest for me. And then zooming out, what am I looking for in terms of like macro perspective? I told you guys in the Discord chat that I'll be sharing what I'm looking for going into the remainder of the year. So I'm bullish for $1 to close out this year. What I'm looking for is, again, these upside targets I gave on the weekly chart here. But now above that, we have what? Our equilibrium price point here of this entire range that we're in. So I'm at least expecting the market to draw up to equilibrium. That's just the easy low-hanging fruit draw liquidity. And then from there, we have an up close candle. So that's a bearish order block at equilibrium. So that's going to be my draw liquidity here as we proceed forward into November. And you can see this line here extended through. What that's anchored to is that up close candle at equilibrium, which is a bearish order block. So those are my targets on the upside for, we'll say, going into January here, and then we'll reassess as we proceed forward here. Oh, and I know I changed the time on you guys. Usually we do 2 p.m. Eastern. I did 1 p.m. Eastern here, but no worries. The recording is always going to be uploaded for you guys if you're not able to be here at the start when I'm live. It'll be just as good a few hours from now as it is now. So that's what we're looking at on dollar from the daily chart. Let's keep working down into from the weekly chart. Now let's drop down to the daily. So on the daily, you can see we drop down. We hit that monthly bullish order block, which is that blue rectangle here. So we dropped down, cleared out the stops here. So stops cleared, and we hit midpoint of the monthly order block. And then we see what? Displacement away from that. That's bullish. That's indicating institutional sponsorship. From there, we had this range low here, this range high. We retrace. I told you guys that was a drop to equilibrium or to a discount market. What I mean by that is this low to this high. They're just sinking it into a short-term discount to take it higher. So in other words, internal range liquidity to external range liquidity. Why am I able to see that? Why am I able to map that out for you guys? It's because I understand the higher time frame, right? So because the monthly and the weekly is bullish, it's really easy to map out what the daily chart should do with that context. So we drop down, we hit this inversion gap here, nice reaction higher. And then if you guys recall this last week, I told you guys as long as we remain above this inversion fair value gap here, we would be bullish. You see we dropped down Monday, Tuesday, made the low of the week, but the bodies are respecting that inversion gap. And more specifically, you can see here we're hitting the bullish order block here. So this last down close candle that drops into a discount market, extend that through, that's your bullish order block. When I'm telling you we're looking for higher prices, and you can see from here we rally. Was a bit sloppy here with a lot of back and forth, but nonetheless still delivering with clean bullish order flow to the upside here. So this 50% level, that's that weekly wick. I like how we laid a body over top of that. Going forward, I don't want to see the market get below this daily fair value gap here. So we have a small little gap there. In my mind, the market has no business getting down below that. So it can hit it, trade into this bullish breaker here, but I would not want to see it lose this gap if we're going to remain bullish longer term on US dollar. And then upside target's going to be these equal highs here. And then through that, we have that monthly gap that we were talking about. All right, further refining down to the 4 hour, you can see here that's that black line there. That's that bullish order block. From there, nice expansion higher, retracement into the gap, and off to the races here. So want to see that continue for dollar. All right, moving right along into the bond market here to confirm what we were looking at in dollar. If you guys remember last week, I told you guys we were going to see bearish bonds, weaker bonds, and that's going to support a higher dollar. So again, it's intermarket analysis. It's how all these factors come together that give you the precision that you're looking for, that you guys want to be trading with. And the fact that the dollar is bullish, we want to see that supported with weaker treasuries. And what do we see on the weekly candle here for treasuries? A bearish down close. So that's going to support a bullish up close in dollar. So you see the ebb and flow of risk on, risk off, the bonds, the dollars, and then what did stock indices, equities do this past week? Weakness, right? So weakness on the back of the strength in the dollar, and the strength in the dollar further supported by weakness in the bonds. So you see how that ebb and flow of risk on, risk off comes together, and it's going to give you that precision element that you're looking for. So weakness in the bond market here. And what we talked about last week here was the SMT divergence here. If you're a noob and you don't understand, SMT is not just limited to the bodies. I taught you guys that last week. So you might not see a SMT divergence here if you're just looking at the highs here. But what I'm looking at, what you want to look at, is the bodies as well. So if you look at the relationship here, the 5-year treasuries did not clear the bodies here. So that is an SMT divergence in and of itself. And you can see how that lended well to our analysis for weaker prices. So don't just look at SMT with the highs, also look at SMT with the bodies, because the bodies tell the story, wicks do the damage. So always apply that when you're using your SMT analysis. SMT in and of itself isn't anything too crazy, but if you understand what you're looking for, like for example, last week we were looking for lower prices, and then you have that SMT, it's just a nail in the coffin, further confirming what you're looking for. So by itself, it's nothing special. It is a good confirmation tool, though, if you already understand what you're looking for, which I'm giving you guys here, free 99. So looking at the daily chart here, going forward, we saw the SMT, it held, we broke down, so easy money last week for lower prices. What I'm watching now is going to be this daily gap here. So this daily gap that we're in now, I'd like to see the market hit that, sell off, and rotate lower and not get above that. If we trade through this daily gap, then I'm neutral on bonds. But as of right now, we need to sell off from here, attack the lows here, and that will create some good trading opportunities for bond traders. So looking for lower prices on treasuries going forward. And again, that's going to further support currency. So for you guys that are trading foreign currency like euro, pound, I'll cover that here in a moment, but you can see that daily gap here. So we'd want to see it hit that, sell off, and that's going to be easy money for higher prices on dollar and lower prices on foreign currency. So for our foreign currency traders here, just to show you guys, we got targets delivered this last week on pound. You're going to have to go back to one of the lives that we did, I think maybe 4 weeks ago, maybe 4, 5, 6 weeks ago, because we called this a long time ago. So it's not going to be last week's, maybe not even the week before. It might have to go back 4 or 5 weeks, because as you can see, we're looking at a weekly chart here, and we were bearish on euro 6 weeks ago. So we were way back here when we were calling these equal lows to you on the pound. So looking at the daily chart here, it's a really nice drop here. If you guys remember, the other component that I talked to you guys about to frame that reversal was also the SMT divergence, right? So the SMT between the euro, right, and pound. So for those of you guys that are trading foreign currency, you got to really be dialed into what we're talking about here. Strength in dollar, all the factors that I talked about in dollar, monthly, weekly, daily, why it's bullish, why we're going to see a monthly bullish candle, a weekly bullish candle, refining that all the way down to the daily chart, and look at the amount of precision and clarity that gives you. Because if you don't understand that and you're trying to trade the Forex market, you're just going to get smoked because you're trading blind. You don't understand where the markets are reaching for. But with this understanding, you can see if we're having a risk off scenario, which is higher dollar, lower foreign currency, then it's going to be easy to trust your sell models. And what do we have here? Obvious equal lows with the SMT. So why is the SMT important? Because if I'm trading currency, am I going to short the pound or am I going to short euro? Euro blows, right? Euro didn't even get close to these lows here. It's just been shit. It's been dropping, don't get me wrong. But I told you guys way back here which one was going to be the best shorts, pound. And you see it's already delivered these lows here. Feeling generous, I'll go into a little more as to why I was looking for pound to be weaker. If you look at the relationship between euro pound itself, euro pound is what? Bullish. So if euro pound is bullish, that means what? Because euro is first in the name and it's bullish, it means it's going to be stronger. And then the pound's going to be weaker. So if you're trading foreign currency, you also have to look at this as well. This is why trading indices is easier. Foreign currency just requires more moving parts. Because if you don't know what bonds and the dollar's doing, and you're trying to trade the euro or the pound, you're just gonna get fucking smoked, right? So you have to absolutely understand what these other markets are doing if you want to trade them with a great degree of confidence. So looking at the euro pound, it's also bullish. So that's why you're gonna see pound over deliver on the downside because of relative strength analysis. So nice little plunge there, finally delivered those equal lows. So for swing traders, that would be a good place to pay yourself there on that nice little swing. And again, it's the weaker market because euro pound confirmed it with the intermarket analysis, but also with just simple SMT divergence here. And it's a simple basic little concept, so it's nothing too special. And then again, the biggest thing is just the fact that the dollar's bullish, right? So that's going to send all foreign currency cratering for the most part. So that's the importance of bonds, what we were talking about there with the bonds and the US dollar. All right, let's get into indices. So looking at the monthly candle here. Hello, Raj. Thanks for joining, sir. Alrighty, so looking at the monthly candle here, not going to spend too long on the monthly chart. We just saw a bullish monthly close in the month of October. And again, indices just keep driving higher, right? So it's just all-time highs, buy models looking for higher prices on NASDAQ, at least as it relates to a higher time frame perspective. We're going to sort that out further as we get into the lower time frames here. All right, so looking at the weekly chart here, we just need to see this on the hourly. So weeks, days, there we go. And this one, this week's good. Okay, so last week we saw a gap higher on Sunday. Gap higher, from there we expanded. And then from there we rejected the highs. So we weren't able to sustain the highs here. This is generally indicative of at least a short-term retracement to reversal. So what I'm going to be looking for here on this next weekly candle is going to be for the market to simply want to drive down into that new week opening gap from the previous week here, which we were actually highlighting last week as well in pre-market analysis. So for you guys to see here, let's see if I can get this moved over. Sweet. All right, here you guys go. So on 10:30 the day before Friday, which was Thursday, so calling for the S&P to drop down into previous day's low and new week opening gap here, and then we're calling for NASDAQ to deliver into its daily fair value gap and into this low here. And then if you look at the time, I'm sharing the screenshot at 9:20, so 8 minutes before the market open, delivering the winning lottery numbers every single day for free in the Discord. Join, links below. Team just sent it in the chat. And then the next day would be nice to have these winning lottery numbers as well, right? Relatively equal lows, obvious draw on S&P and NASDAQ. Shared that at 9:27, so 3 minutes before the open again, winning lottery numbers all given for free. And then even taking it a step further and sharing with you guys how I'm banking on the levels that I'm giving you guys as well. 9:35, not even 8 minutes later, nice little $500 payday after a few minutes of work here with the levels that we're sharing before the fact. So for those of you guys that aren't getting the pre-market analysis, trading blind, I don't recommend it. Get the winning lottery numbers, and like I said, all for free, by the way. So sharing that information with you guys, and that's kind of an update because I know what we share here is what I'm looking for going into the week, but sometimes that changes, right? Sometimes I get different insight, have different information, I need to pivot. And if you want the most up-to-date information with what my bias, what my drawn liquidity is, what levels I'm going to be actively going in and trading off of, be sure you're looking at that market analysis tab in our Discord for free, by the way. All right, so working down into the daily chart here. So we have this new week opening gap here, this big exposed area here highlighted. That's going to be a draw later on. So looking at this here, now that we're down into the weekly chart here. Hey, Paul, bit late to the party, but never too late. Yeah, glad to have you, Paul. No problem, brother. All right, guys, so looking at the date, only 8 likes, guys. Drop one, free gems here. I appreciate you, Paul. Yeah, do hit the like button on your way out if it's helpful. I think I changed up the time on it, Paul. I think psyched everybody out starting an hour early. It's all right. The recording will be out. So daily chart here. We saw a swing high here. So 3 candle pattern, 1, 2, 3. Candle 2 is higher than the one to the left and to the right of it. That's a swing high. Whenever you get a swing high pattern, generally, not all the time, right? Again, you can't just be a pattern trader, but these are general rules that I use. So if I'm already looking for the market to draw lower for some reason, and then I see a swing high form on that daily chart, it just gives me a lot more confidence that candle number 4 is going to be bearish, right? So we talked about the swing high pattern as candle 1, 2, 3. Whenever you have a swing high, the bias for candle number 4 is usually a pretty easy short and a continuation of whatever that swing was. Like, for example, you see here, let me see. So, for example, you see this swing low here. On this swing low, candle 1, 2, 3, candle number 4, bullish bias. Right. And again, it's not a guarantee for every single time you're going to see a swing low. Same thing here, right? Candles swing low, 1, 2, 3. Once you get the swing low here, candle number 4, easy bullish bias. So it's not all the time, like as you'll see. Let me find one that fails here, right? So candle 1, candle 2, candle 3 creates the swing low, and then candle number 4 you see doesn't expand higher. So I like to show you guys also examples that fail because it's not just as easy as, oh, well, just find the swing high, swing low pattern trade this, and it's easy money. It's not. You also have to understand context as well. So swing high here. What I have labeled here is the consequent encroachment or the midpoint of this wick here. You see we opened on Friday, rallied, couldn't get up to the wick here. That's signaling weakness. It's heavy. It's bearish. So as long as we stay below Friday's high, I'm bearish. Looking for Thursday's low as the first draw. Through Thursday's low, I like this new week opening gap here. How we trade inside the new week opening gap will give me everything I need to know. If we trade through to it and through it, then I'll look for these 2 down close candles here as the draw. And then I'll have to see how we trade from there. If we drop down into it, find support, accumulate, and trade higher, then we're probably back at all-time high protocols looking for higher prices. However, do keep in mind that if we start to see a lot of strength in dollar going forward, like this thing really starts to rip because the United States is taking military action or trade wars or whatever the case may be, if we start to see a lot of speed higher on US dollar, that will cause weakness on indices. However, again, we're at all-time highs. We have been just about all year. And as I've been saying, you don't want to be the guy trying to call a top every single week. It might look sexy. It might, feel good to try to call a top, when it's starting to look like it's rolling over. But as you see, that's a loser's game, right? And there's people that trade like that. Like there's people that are literally trying to call the top every single week, and they're not in the game very long trying to do that. So yes, you can map out short-term retracements, but trying to call a long-term high in a bullish market is just a really hard game to play, as we've been discussing here at great length. So while right now I think a short-term retracement is warranted, if this is going to be a long-term high, we'll see that when it's priced in, and we'll be able to use that information as we get it. So I guess I'm calling for lower prices on the short term, but I don't want it to rip your face off if this thing starts just shooting higher based off whatever's going on. So do keep in mind that's how I'm managing this information. This is the initial draw. Then how we trade there will give me the insight I need to proceed forward. And then for the hourly chart, just to refine this here a bit further for you guys. All right, so you can see we opened here on Friday, traded higher, couldn't get to 50% of that daily wick here. We then broke down. We also have this daily, or sorry, it's hourly fair value gap here. Bodies respected it, broke down below it, hit it, use it as a inversion fair value gap here. No, that would not be an inversion. In fact, that would be a reclaimed fair value gap. So this would be a reclaimed fair value gap here. So hit that, respected the midpoint here, and then broke down. What I'm watching here is we have this hourly fair value gap. You can see we traded higher, snap lower, closing below consequent encroachment. So in my mind, that's bearish. I would not want to see us get above this up close candle here, which is a bearish order block. So as long as we remain below the 10 a.m. Friday candle on the hourly chart for NASDAQ, I'm bearish, looking for, again, Thursday's low, these relatively equal lows here, and then we have this large gap here in price that I'd like to see the market draw down into. Then how and when we trade there, again, will give me all the insight that I need from that point. So that's what I'm looking at for NASDAQ. For S&P, yeah, it'll be the same deal. S&P is weaker. Here you can see. You see that wick here that we were looking at on NASDAQ? S&P could even get up to consequent encroachment. So it stopped at its lower quadrant here. So it's telling you it's really weak. So S&P is a lot weaker than the NASDAQ is. So what we'll be looking for on S&P, for the S&P traders, we'll look for a full fill of this gap, which would just be repricing down to this candle's closing price, or the low of that week opening gap. Then from there, we have this bullish breaker as a target that we could look for on the downside. And that's what we're looking at here for dollar. So for ES. So going forward, that's what we're looking at. Top down. If we look at the, yeah. So yeah, same thing for S&P as we talked about on NASDAQ. Would want to see us stay below this 10 o'clock candle now that we shot higher, broke back down below it. So that's the business there, guys. Any questions for me here before we get going? Look to take a few before we proceed. And then we'll take a look at the usual. All right, so crude oil, we talked about last week. I'm not going to go into too much detail. We talked about spoke about this mostly last week here. So still watching this inversion gap here. No, not this one here. Here we go. So still watching this inversion gap here. You see we drop down into it. You see the bodies there hugging the low of it. So the wicks coloring outside, the bodies are still respecting it though. I want to see if we can stay supported inside that inversion gap. If we start to rally from there, then that would be bullish for me. So I'd look for higher prices off that, as long as we respect it like we're seeing here. And that's the inversion fair value gap we were looking at last week. And if you see the market, how it's respecting it. So this isn't after the fact, putting the levels on the chart, showing you, hey, look at what the market's doing. These are levels we were watching last week. And it's very consistent that the market behaves at these levels in very specific ways if you know what you're looking for. Meaning, if you're bullish, we want to see the market ideally stay in the upper half. Ideally not even get to the lower half. But if it does trade in the lower half, you want to see something like this. Like the body's indicating they're not willing to go below it. And then from there, we'd want to see a lot of speed to the upside. So that's what I'm looking at on crude oil. We do want to keep in mind, though, crude oil longer term has just been a mess, right? We've just been inside this nasty range here. So still managing expectations, but on the lower time frame, if we do start to see a ramp up with geopolitical events around the world, then that will put a lot of pressure on gold to the upside, or pressure on crude oil. Speaking of gold, we saw the retracement down into that weekly gap. So if you guys remember last week, told you guys that the weekly fair value gap here would be the likely draw on liquidity, and you see we opened, we dropped down into that weekly gap. Now I'm waiting for more information. How we trade here is going to tell me everything we need to know. Meaning, do we find support here inside that weekly gap, or do we start to melt through it and we see a deeper retracement? I'd welcome any lower prices on gold. Any lower prices on gold will create a buying opportunity. Not financial advice, but for long-term investment purposes, for being able to preserve the purchasing power of your wealth and your money, gold is going much, much higher longer term. So in my opinion, again, not financial advice, any retracement, any discount you get on gold and silver is a dip buying opportunity. That's how I'm looking at it. Abdul, so a little bit of it, yeah, so covered crude oil, gold, touched on euro, touched on pound. Yeah, we're good to go. All right, guys, I'll take a few questions. We'll get going. All right, Abdul, a bit of an in-depth question. Let me hear it. So when you have your overall bias, yeah, that's an excellent question. Hey, Jeff, thanks, Dylan. Looking forward to getting to work next week. Absolutely, Jeff. Have an amazing weekend. Take care, sir. So yeah, Abdul, great question. So when you have your overall short bias, let's say for cable, how do you change your bias, or what makes you change your bias for a day that you might think it won't drop? Yeah, good question. So that's the thing with bias, right? Let's look at let's look at pound. Pound's a good one. Pound's starting to move well. All right, so how do you find bias? The simple down and dirty way to find bias is, where's the weekly candle going? Because if you understand where the weekly candlestick is likely to draw to, 90% of your daily bias problems are solved. So looking at the weekly chart, if you understand what that weekly candlestick is likely going to gravitate to, then again, 90% of your daily bias issues are going to be solved. So if we're seeing that, okay, we rallied higher, we saw the S&T here, we're seeing bearish order flow on pound. And if you don't know how to read your order flow, watch my recent video on the One Setup for Life. I'm going to show you how to read order flow in a basic way, right? There's a lot more that goes into it. There's a lot more depth behind institutional order flow that I'm not able to fit in just a YouTube video, but that is a great start. And if you aren't that confident in order flow, you're a bit shaky, watch that. It'll give you a great start, at least on the basic free level. So with that in mind, we're seeing obvious bearish order flow here. So what's this weekly candlestick likely going to reach for? It's obvious that it wants to stab down into these lows here. So now with that in mind, that's how you establish daily bias. I didn't forget your question. So now if the weekly is going to expand lower, what does that mean for the daily candle? That means the daily candles are going to be expanding lower into this level as well. Well, now you have to understand time and price, meaning if we're going to see a bearish weekly candle, right? What do you expect on each candle? We expect a formation of a open, a high, a low, and then a close off that, right? That's my shitty drawing of an open, high, low, close, right? So understanding that, what time is the open, high, low, close going to be seen? Well, now we factor in our weekly profiles. So we go into our hourly chart now. And I'm getting somewhere with this, but if you ask an in-depth question, I got to give you an in-depth answer. So want to make sure you leave this here knowing what I'm laying down here. All right. So if we understand that the weekly candle is going to look like this, right? And we're likely going to see something like this because our monthly bias is bearish, because the weekly bias is bearish, because the daily bias is bearish, and we're bullish dollar, and we're seeing lower prices on bonds. So it's a loaded deal for lower prices in the cable market. Now, just understanding lower prices isn't enough, right? Because you don't want to go in there Monday trying to sell short and get smoked. So now this is what you have to understand as it relates to timing elements and daily bias. So the reason educators teach daily bias, ICT himself, me included, is because as a developing newer trader, like those I'm coaching, those I'm working with, you want to focus in line with the bias. Meaning, if you're trading cable and you're working with me, and let's say you're in your first year of finding your profitability, do you want to go long or short cable? Obviously, easy money for shorts. Well, the bias, the daily bias, helps frame that direction, meaning this is the direction you're going to send your shots down. So your shots are going downrange this way. And doing that is going to save about 80% of your problems as a newer trader, because you don't want to try to go long this and swim against the tide as a developing trader, because the chances of you being profitable in it are slim to none. Now, as a more seasoned trader, you can trade every day because you understand these things here. Now, let's look at the open, high, low, close from this perspective. We have the opening here Monday at midnight. If we're bearish, what do we want to see first? A manipulation. Why? Because that's going to be the high formation of the weekly candle. So on Monday, we see a manipulation higher. So that's one strike against, well, we have a daily bearish bias, But why wouldn't you go short on Monday? Well, that's when we expect the manipulation or the high of the week to be formed. So we wouldn't reasonably expect to go short on Monday. There's one example of when you have a bearish bias, but you're not going to short it because you understand power of three. Let's look at another example, Friday. After these targets are already delivered here, why would I not go short? Because it's Friday and we've already priced in the low of the week. Targets have already been reached. So the low of the week has already been priced in. And now we're more likely to see what? The retracement off the low to close off the low here. So Friday would be another example where if we're drawing down into targets, you can short it. But if we already reached those targets, I wouldn't go short even with a daily bearish bias on Friday because it's time of the week, day of the week, for the market to retrace and create the extreme off the low. But I would go short Tuesday, Wednesday, and Thursday. So you see how all that information comes together, but it's all rooted in time first, then price. You have to understand power of three on the monthly. You have to understand power of three on the weekly, on the daily. And then when all those factors come together, I mean, look at just what a beautiful tapestry price is when you understand that. So the key is understanding time. Then within that logic, you'll know when the market should move in your direction or against it. So a bit of an in-depth answer, but that's how you know when it's going to be bullish and when it's going to be bearish. So now if we've already priced in the high of the week Monday to Tuesday, which is when you look for the high of the week to form, then you can trust that from Tuesday all the way down to Thursday, you're looking for sell models, looking for lower prices. So if you understand the weekly power of three and how that relates to the monthly power of three and just how all those factors come together, then you're not going to have any problems knowing when to go long, when to go short, if you understand time and price. Great question, Abdul. Viking, hey man, I watched your one setup for life. Thanks for putting that out there. I'm a London session trader. So does the 9:30 open be the same as 2 a.m. open? Excellent question, Viking. Yes, sir. Yeah. So you can use the 2 a.m. open and the midnight open as well. So very similar to how, like in the AM session, you can use 9:30 as an opening price, but you can also use 8:30 as an opening price. Same thing in the London session. So you can even use midnight and you can use 2 a.m. So that gives you two opening prices to work with, and you can use the same exact procedures that we talked about in the one setup for life. Absolutely. Awesome. Excellent question, Abdul. Excellent question, Vikings. I think we will close with those. Samrat, NQ bias this week? Bearish. All right, Islam, we'll go and wrap up with yours, my man. All right, so when price respects two fair value gaps on both sides, how do you identify the correct direction from like the daily time frame for gold? Whenever you have conflicting models, always go to the higher time frame. Let me show you what I mean here. So let's say you're looking at this here, right? And you're trying to determine right now, right? Like we're just going to look at this fractal and price action here. What's the question you always get? How do you know if it's a market structure shift or if it's just a stop hunt, right? Like let's look at this example here. So let's say we have this example here. We have an old high that was traded above. Well, Dylan, is this a market structure shift to continue higher? Or is this just a rate on stops to continue lower? That's a good question. Well, it depends on higher time frame. The higher time frame is always going to be parent to the lower time frame, meaning if you have conflicting models, you always want to go with the higher time frame. It took me a long time to learn this. You're going to want to pay attention here. If the market, let's say this is a daily chart, and this is a swing high on the daily, and we took out this high. Well, Dylan, how do you know if this is a bullish shift in market structure or if this is just taking the stops to go lower? Well, then I have to understand what's the weekly and the monthly doing. So now if monthly and weekly institutional order flow is bearish, and then we take out the highs here on the daily chart, then this is just going to sweep the highs to continue lower. But now let's say monthly, weekly institutional order flow is bullish, or we just reached a key discount level on the monthly, weekly, and we expect a bounce in price action. Well, then if the higher time frame model suggests that we could be bullish, then we could trust this as a bullish shift in market structure, retracement, continue higher. So whenever you have conflicting models, the higher time frame is always going to win. So now let's look at the example you're talking about here. So you're saying, well, on the daily chart, we got two fair value gaps. Well, fair value gaps themselves are just a tool, right? So I know a lot of people, especially if you are just familiar with the concepts, a lot of people get stuck trying to pattern trade this. Guys, the fair value gaps, the order blocks, they really don't mean shit by themselves. It's how they're going to be used in a narrative that you're looking for that matters. Meaning, like, I'm not just going to look at, well, there's a random fair value gap here, random fair value gap here. You know, man, what are we doing? I'm going to understand what's the higher time frame doing, or I'm going to look at and try to ascertain the information as to what's the higher time frame going to do, right? So if we look at the monthly, okay, higher time frame, we're bullish. We look at the weekly, okay, higher time frame, we're bullish. We just saw retracement down into this weekly gap. So I'm staying looking for higher prices, right? I'm not trying to short a bullish market like this that's at all-time highs. It's reasonable for it to retrace. We called that last week down into that weekly gap. And then I said, now, once we get there, we're going to have to see how we trade there. So now that we hit that level, what's the higher time frame models indicating? Monthly, weekly. We're bullish. We're looking for higher prices. So now what I would do on the daily chart is this gap here has less weight on my analysis in terms of selling off from this level than this gap here. So because there's a conflicting model here technically, right? As you mentioned, there's a bearish fair value gap here and a bullish gap. So how do you know which one to use? Well, then you have to understand the higher time frame, because that's going to resolve the lower time frame conflict, or the confliction in your analysis in the lower time frame will be resolved with the higher time frame parent understanding. Meaning, all right, we have this gap here and this gap here. If we're going to be bullish off that weekly gap that we traded down into, it goes without being said that we're going to trade to and through this fair value gap here. So with the limited information I have right now, right, not understanding how the market's going to respond to all the crazy shit that happened over the weekend, right? So with my limited perspective before Sunday's open, I would expect this fair value gap to fail and for the market to trade to and through it. Simply leaning on the logic I just covered in that example, that if there's ever a conflict between the higher and the lower time frame, the higher time frame is always going to win out. So it makes it easy to know how to filter and how to know which levels to use. Viking, thanks, Dylan. Yes, sir. My pleasure. Samrat, thank you. Yeah, glad to be here with you guys. Abdul, thanks, Dylan, for the in-depth info. Yes, sir. My pleasure. So, Abdul, so what you mean is, if I understand correctly, ICT models are not a pattern at all. Exactly. Absolutely. It's based on what you believe should happen because of price printing in such a way. Yeah, absolutely. Definitely. So same thing with like dollar, right? For example, why am I able to say, right, this is a bullish fair value or a bullish order block here, right? Why am I able to say that this is going to be an inversion fair value gap and send this thing higher, right? How am I able to see those things, right? How am I able to see that, okay, this is a dealing range here. We dropped from a discount and now we're going to rally up to a premium and attack these highs here. And it's going to be a move from discount to premium. Like, how am I able to map those things out? It's not the pattern itself. So don't get caught up on, oh, it's the order block that told them that. It's the fair value gap that's telling them that. No, it's, I know what price is going to do top down, monthly, weekly, daily. Then if I understand what it's going to do, the algorithm is going to behave at these PD arrays in a very specific way within the narrative that I'm already looking for. So the key is narrative. What's the market drawing to and why is it going to draw there? Month one, draw liquidity for those of you guys that work with me. Because once you understand the draw, everything else falls into place, right? Because now look at how easy it is to map out this price run here with a bullish bias. But imagine if you had no idea what the hell the market was reaching for, then you'd just be looking for random patterns, right? You'd be here thinking, oh, well, there's a bearish fair value gap and a bullish fair value gap. How do I know which one to use, Dylan? Perfect example, right? Why is it going to trade to and through this gap? Just like the gold example I covered. Because monthly, weekly, daily, we're bullish. So the parent model is bullish. The lower time frame model, you may say, oh, there's a bearish order block, it should sell off. But it's not going to sell off because higher time frame the parent time frame is bullish. So it's an understanding of top-down analysis and then understanding how these PD arrays are used by the algorithm. And it's pretty straightforward when you understand them in that sequential order. So yeah, that would be correct, Abdul. Tay, what's the difference between a BISI and a fair value gap? It's the same thing. It's just a classification, right? So a great question. So a fair value gap is an inefficient range in price that's looked at as fair value, right? But now there's two different kinds of fair value gaps, right? Because we have this fair value gap here, right? And we have this fair value gap here. How do we distinguish between these two? This is a SIBI, a sell side imbalance, buy side inefficiency, because it's inefficient in buy side. It's just a one pass lower, and this is just one pass higher. So a BISI, or a buy side imbalance, sell side inefficiency, is just a classification of a fair value gap. So they're all fair value gaps. It's just a SIBI is a down close fair value gap, and a BISI is an up close fair value gap. The reason that's important is because it's a SIBI because it's a sell side imbalance, but it's inefficient in buy side, meaning it was one pass lower. So it only offered sell side. So the algorithm is going to want to do what? Take price higher back up into it and offer buy side because it's inefficient in buy side. So it's going to want to see an up close candle, trade through that, and you get that here. Now, same thing with the BISI here, right? With the buy side imbalance, sell side inefficiency. This is just one pass higher. Yes, it's a fair value gap, but by classification, it's a BISI. So it's what? Only one-sided in price action higher. So it's going to want to do what? Trade back down into it and offer sell side delivery, offer a down close. Because it's very similar. What really helped this click for me was the paint roller analogy that ICT teaches. When you're applying paint on the wall, if you just go up the wall once, it's not going to be efficiently delivered. So it's going to want to come back down and offer paint in that same range once more so that the paint can be efficiently applied to the market when it leaves. So that's the way I look at it. Really helps keep it simple, and that's the difference between a BISI and a SIBI and a fair value gap. They're all the same thing. It's just simply a classification of fair value gap. Yeah, Tay. So it's really just a matter of what you're comfortable with, right? So if you just want to label it fair value gap, the most important thing is that you understand what I just covered here. If you understand what I touched on here, that's all you need to know. How you label them isn't as important. The most important thing is that you understand how to use the level. Summerat, Dylan, can you check NQ, please? I already did, brother. NQ is part of the main staple in the analysis here. So that's going to be at the beginning. You can either fast forward, or as always, the recording will be up and you can take a look at NQ. As I'm not going to go over it again. Eslam, thanks. Take care. Yes, sir. Appreciate you joining, brother. Joe, always welcome the model reminders within their specific narrative and examples. Thanks, Dylan. Enjoy the rest of your Sunday. Yes, sir. Glad it was helpful, Joe. Appreciate you, man. Tay, okay, so when I'm marking out both, yeah, already answered that. Yeah, so it's less important as to how you mark them out. The most important thing is that you understand how to use them, right? And how to use them is what I covered here. Where's the higher time frame going? And then when you understand the draw on liquidity, these levels perform and behave in a very specific way. Abdul, awesome. Thanks, Dylan. Well said. Yeah, appreciate you joining, Abdul. All right, guys, that's going to be it for today. Appreciate everyone joining here. Thank you very much for your great questions and your feedback on the YouTube videos. Very much appreciated. And as always, let me know what you guys want to see more of going forward. I will be sitting down, hitting the drawing board, seeing what other content we'll be doing. But I want to hear from you guys what would be the most helpful content and what's going to move the needle the most for you guys. So I'll be on the lookout for that as I'm making lessons plans here going forward. And we are just getting started on the YouTube. So if you guys like what you guys are getting, much more to come. And with that being said, guys, have an amazing rest of your Sunday. I will see you guys on the next one. Bye, everybody. Yep, goodbye. Take care, Abdul. See you guys later. Yep, take care, man.